Welcome back to Squawk Box this morning. Take a look at futures because we are in the red. It's gotten a little bit better, but not much. We're still off about 600 points. Well, actually, maybe it's coming even as I'm speaking. Well, it's oscillating. About 500, we'll call it 575 points off right now. S&P 500 off about 56 points. NASDAQ looking to open down about 131 points, maybe 130 points right now. But do take a look at some of the stay-at-home stocks like Zoom. It is up this morning. You're looking at that stock up about close to 2%. And then check this out. Shares of Shopify, some news to bring you this morning. Walmart now deciding to team up with the company to open Walmart Marketplace to Shopify's sellers. Now, Walmart says it'll start to integrate new sellers and expects to add 1,200 Shopify sellers this year. That stock up, the Shopify stock that is, up about 4.5%. Big news for Shopify there. Meantime, Hertz has won approval from a bankruptcy court judge to sell $1 billion in stock shares. The car rental company is trying to take advantage of recent rally in its stock as it tries to raise money. Hertz shares had jumped as high as $6.25 per share last week, but came down off those highs in subsequent weeks. And as we all know, at least typically in a bankruptcy procedure, the equity is worth close to zero. So who knows? Strange times, Joe. Strange times.
Mm-hmm. All right, Andrew, thanks. Coming up, entertainment and media stocks in focus as names like Disney and Comcast reopen theme parks. But will flare-ups and outbreaks of the virus keep people from going? We're going to speak to Michael Nathanson after the break. And then later, David Gerstenhaber, CIO of Acorn Advisory Capital, joins us to discuss market volatility, whether you're putting money to work or not putting it to work, or at least not in the stock market right now. Squawk Box coming right back.
Land Rover, above and beyond.
There's a lot of sameness among online brokers these days. IBKR stands out in the crowd. We offer the lowest trading and borrowing costs. Our clients have the choice of investing globally or locally in stocks, options, futures, forex, bonds, and funds from a single integrated account. Our premier technology enables you to optimize speed and efficiency, perform sophisticated portfolio analysis, and manage your accounts. Start investing today at IBKR.com.
Before you get back out here, gear up at Dick's Sporting Goods and Golf Galaxy. Grab a new Callaway Maverick, a tailor-made SimMax, or save up to $180 on select equipment. Plus, pick up a box of Callaway Chrome Soft golf balls. Check out our newest selection of footwear and the hottest new apparel. You'll earn triple points on new equipment purchases and 50% more on your trade-ins. Shop in store or shop us online and pick up curbside. All from Dick's Sporting Goods and Golf Galaxy.
This dog is my heart. I want her to live the happiest life that she could have. To make sure she gets the best food is an easy investment for me to make. Roxy loves Farmer's Dog. It smells good, like something I could eat. Comes in these convenient little packs that you can tuck into your freezer. Made my life so much simpler. I want her to have a long and healthy life. Farmer's Dog is a good answer for that.
Visit betterforthem.com and discover your dog's recommended meal plan.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school.
Call IU, then tell them your dream.
1-800-967-1179. 1-800-967-1179.
Welcome back, everybody. The recent rise in cases in China and some U.S. states may put the brakes on how Disney, Comcast, and other theme park operators go about reopening. Joining us right now for more on all of this is the Squawk News Newsline is Michael Nathanson. He is founding partner and senior research analyst at MoffettNathanson. And Michael, what do you think? We're hearing about this resurgence of cases, and that's probably why you see the futures under so much pressure this morning. What does that mean in particular for the media stocks?
Well, Becky, good morning. It underscores our concern that the kind of the return to normal at Disney and Comcast parks is going to take a while, right? And when you look at the attendance composition at Disney parks, there are all types of people who come. Some people live in Florida; they drive up for the day. Others drive down from other states close by. And then people fly in from other parts of the country and the world, and all those customers, pay different amounts of money in terms of to Disney and Universal. So our feeling is that this is going to take longer to return to normal, and the recovery in Disney's earnings will take 2-3 years from where it was in 2019.
What does that mean in terms of where the stocks are now? Are they fairly priced? Are they anticipating that?
Yeah, so it's interesting. So we downgraded Disney in early May ahead of the quarter because the stock had run so much in our mind. It then kept running. But our feeling was that the market had lost track of the time to recovery for Disney parks. It's not a next year they're back to normal. It's a multi-year problem. And then for Comcast, we're bullish on Comcast, but their parks are a small slice of the story. There it's about cable. As you know, cable, it's our broadband. Broadband is very, very sticky. The other question, you can ask then is, what does this mean for the NBA and other sports who want to go to Florida and pretty much, get into a lockdown mode and finish their seasons down in Florida? And that's an open question as well after seeing some of the spike in cases the past couple of days.
You said that this is multi-year. The anticipation, or at least the hope, is that we were just, speaking with the doctor about this, but the anticipation and hope is that you'll get some sort of therapeutics and potentially a vaccine by the fourth quarter of this year, maybe by early next year. You don't think that this changes if there are therapeutics and vaccines that would make people feel more comfortable about traveling, or you think that it is then an economic knockoff, that people won't have the money to travel?
Yeah, Becky, that's a good question. We focus on the second part. We focused on the economic impact, right? Like when we looked at previous economic slowdowns, that's the multi-year recovery we're talking about, right? I'm not the health expert, and we're assuming that there's a vaccine that's going to come. But when you look at other recessions, it does take 2 or 3 years for people to feel comfortable again economically to go back, right? It's just it's different types of consumers, right? The Florida drive-up customer will go back with an annual pass. That's easy. The 7 to 10 day northern visitor may not have the money or may be holding on to their cash more post this slowdown. That's what we're talking about. It's really the second issue and not the first one.
The weird thing is that in the early days, consumers have a lot of money to spend, sometimes more money than they might have had otherwise, because of all the massive amounts of stimulus that's been poured into the market at this point. You think that stimulus dries up, these people don't have their jobs, and that's the other wild card here, trying to figure out how much the massive amount of stimulus changes this recession and makes it look different than other ones, too.
Yeah. Well, Becky, one of the things we're going to talk about before, the news of spiking COVID was changing consumer behavior. What we're seeing is real growth in SVOD services, right? So you're seeing growth, of course, in Netflix, in Disney Plus, which is good for Disney, in all types of new SVOD products, right? So what we think is happening is that there's a mix shift happening. People are cutting the cord. They're saving money on, their bigger cable package, and you're seeing much more growth in entertainment spending on SVOD and the gaming, right? There's a mix shift. So you're right. Like it's not a blanket statement, but there are parts of the media ecosystem that are benefiting from this change, where dollars are moving into, and that's going to have lasting impact as well. And as people cut the cord and move to more and more SVOD services.
So you cut your rating on Disney shares. What about Comcast and are there stocks that you like?
Well, Craig, as you guys know, Craig Moffett covers Comcast, and he turned more bullish in the spring on Comcast. The stock was really beaten up. His concerns about Sky and the media aspects of NBCU, he thought were reflected. So we like Comcast here. We like Charter. We like all things cable because broadband's the component of that. In media and entertainment, we have a buy on Fox because our thesis on Fox is Fox has two businesses: Fox News. And we're going to talk about ratings before this change. But ratings for Fox, for news, your ratings, MSNBC, Fox, CNN, very strong. And second, Fox is a play on the NFL. And our assumption is the NFL comes back in the fall. They don't need to have the large stadiums filled the way that baseball does. So the NFL could start, and Fox is pretty much a call in the NFL. So we like Fox, and then we're straight down the middle with Google and Facebook. Those are our buys in the internet, and that's been just kind of a relative place to hide, and that seems like a pretty good place to keep hiding. So we're pretty cautious on the media space. We think this recession and the impact of COVID-19 really changes the long-term landscape for media stocks, and Fox is probably the safest place we have in media. And then Craig likes Comcast for the broadband component of that.
Great. Michael, thank you for your time today. It's good talking to you.
Thanks, Becky. See you soon. Bye.
You too. Andrew?
Okay. Thanks, Becky. Coming up, but when we return, a new Goldman Sachs report says mom and pop investors are beating hedge funds this year. We're going to tell you the names they are buying and what all this retail activity means for the market. Check out the futures right now. We are in the red across the board, triple digits in the red, about 600 points off on the Dow. When we return, outdoor dining and non-essential retail are set to resume in New Jersey today. We're going to talk to Congressman Josh Gottenheimer on the state's move. Squawk returns with that and so much more after this.
Ever since we've gone mobile on the Now platform, something's gotten into the office.
I hear you. Feels like there's no barriers between departments now.
ServiceNow, the smarter way to workflow.
There's a lot of sameness among online brokers these days. IBKR stands out in the crowd. We offer the lowest trading and borrowing costs. Our clients have the choice of investing globally or locally in stocks, options, futures, forex, bonds, and funds from a single integrated account. Our premier technology enables you to optimize speed and efficiency, perform sophisticated portfolio analysis, and manage your accounts. Start investing today at IBKR.com.
Organizing your finances can be overwhelming. You've got a mortgage here, loans there, savings and investment accounts, and a million other documents stuffed in that shoebox. There's an easier way with Stifel Wealth Tracker, a free app that brings all of your information into a single secure location. Automatically create your personal balance sheet, view your expenses, understand your investments, and finally, organize your finances. Download Stifel Wealth Tracker and get back to what's really important.
Between wisdom and curiosity, there's a bridge. Between ideas and inspiration, trauma and treatment.
You need a couple of more pounds. That's good for the baby.
Between the moments that make us who we are and keeping them safe, private, and secure, there's WebEx.
Squawk in the Street examines new workplace safety, signs of strain.
Is your trash an indicator of how well or how fast the economy may be recovering?
And what's driving stocks. Today, 9 a.m. Eastern. Watch and listen live on the CNBC app.
Good morning. Stocks pointing to big losses at today's market open. Friday's bounce now looking like it's going to carry over into the new trading week. This hour, we're going to bring you valuable insight from two big market voices. Tiger Cub David Gerstenhaber is going to join us. Allianz Chief Economic Advisor Mohamed Alarian. And the damage from the coronavirus measured all the way down at the street level. We're going to get some exclusive local business data from Yelp that may shed some new light on the pandemic fallout. The final hour of Squawk Box begins right now.
Good morning, and welcome back to Squawk Box here on CNBC. I'm Joe Kerner, along with Becky Quick and Andrew Ross Sorkin. We're down about 600 points right now on the Dow Jones. The S&P indicated down 61. That will put it below 3,000 in percent, and NASDAQ losing quite a bit, down about 140 points. In percentage terms, you can see that's somewhere, NASDAQ below 2%, Dow Jones 2.3%, and S&P down right around 2%. Futures have been volatile throughout the morning, and we saw a triple-digit or 1,000-point loss at one point in the Dow. Now down, it's cut about that in half, and that's just a little more than we gained on Friday. But then you remember on Thursday we had a near 2,000-point loss in the Dow. Treasury yields have backed up. We were threatening 1%. At least we were at 0.9. Now we're 0.669, and the price of oil was threatening to go over $40, and it was 38 and change, 39. Now that's all the way back down to 35. Andrew.
Okay. Anxiety about a resurgence in COVID-19 cases putting some pressure on the markets this morning, as we've been discussing for the past 2 hours. A count by Reuters now showing that states including California, Florida, North and South Carolina, and Arizona all had new records for infections in the past 3 days. Saturday's 25,000 cases nationwide was the most for a Saturday in over a month. The testing, of course, has also increased quite a bit. Many health officials point to gatherings over Memorial Day weekend as contributing to the recent spike in COVID cases. Yesterday, New York's Governor Andrew Cuomo warned that New York City and Long Island officials that their reopenings could be impacted if they don't take steps to curb large gatherings of people. He said the state had received 25,000 complaints, many of them on people not social distancing in places like Manhattan and the Hamptons. Becky.
Andrew, thanks. Earlier in the program, we heard from former FDA Commissioner Dr. Scott Gottlieb on the consequences of letting case numbers get out of control and not doing effective contact tracing for those who have been infected with COVID-19.
We're not going to be able to shut down the country again this summer. We're probably not going to be able to shut down the country again this fall. And so we're going to need to try to isolate the sources of these outbreaks and take targeted steps. If we can't do that, these will get out of control. And so the cities need to be adept at this. I think Arizona, you're going to see Arizona potentially take control away from the counties for the contact tracing work. You're going to see the states step in. These states need to be doing good contact tracing work to isolate the sources of these outbreaks.
Joining us right now to talk about the balance between reopening safely and getting people back to work is New Jersey Congressman Josh Gottheimer. The Garden State is allowing restaurants and non-essential retail operations to reopen today. And Congressman Gottlieb, it's great to see you. Thank you for joining us.
Hi, how are you, Becky?
Good, good. We should point out that there are restrictions still on some of those reopenings. In fact, the governor of New Jersey moved to sue Asbury Park last week after their town council voted to go ahead and allow businesses or restaurants to start seating people indoors again before the state had allowed it. This is a huge push between trying to figure out what's safe, but also trying to figure out how to let businesses get back open and up and running again. Where do you come down on this?
It's a very tough balancing act, and I think we're doing a good job here by opening today phase 2. And retail stores will be allowed 50% inside for the non-essential. Outdoor seating at restaurants will happen. You probably saw over the weekend, the good news is in New Jersey, we're now down to 300 new cases a day. So, we've taken a lot of tough steps here. We've got to help our local businesses. We've got to reopen, but do it safely. And I think everything we consider here is being watched with new cases every day. The key is, as Dr. Gottlieb said, the key is just being vigilant and making sure you watch that balance. But we have to realize we've got to help our small businesses. People want to get outside, but they just have to do it social distance, wearing masks, and being smart about it.
Dr. Gottlieb also told us this morning, though, that don't expect to see places kind of shut down again if there is a pickup in cases that happen once more. You think that's true?
I think it's going to be very tough to shut down the way we did, but I also think we got to watch our hospitals. If our hospitals get overwhelmed, we're going to have to take steps. That's why, as we're seeing in Florida and parts of Texas, where those numbers are getting out of control, it's important. It's really important that we do this safely and that we don't get ahead of ourselves. We're talking about it. I talked to all the small business owners, and we recognize that it's actually why you can't walk away from helping them either, right? And helping on the jobs front, because we know that as we reopen, we're not reopening at the same level we were at. And if we rush it, people will be sick again, and we'll actually have to shut down again. So I think that is the key balance, and I believe in New Jersey we've done a very good job of that so far.
Congressman, you are somebody who tries to work in a bipartisan way whenever possible. I know that's been a huge part of what you've been involved with. But there are some different numbers that are being thrown around right now between the Democrats and the Republicans in terms of what we can anticipate for a fourth package, a fourth stimulus package. The administration over the weekend identifying potentially $2 trillion that they'd like to see, the president would like to see spent. That is less than Nancy Pelosi has talked about, but it is more than Mitch McConnell has talked about. What do you think is likely to happen, and where would that money be spent?
You know, I do think we're going to find somewhere in between, of course, where Mitch McConnell is and what we passed in the House, and that's what we'll get out of the Senate. The key is you're hearing that we've got to get something done. And to me, that's where the bipartisan movement is happening. And it's also regional, right? You've got Democrats and Republicans in these areas that have been hit so hard that are saying our states have been devastated financially. You look at New Jersey, we've got probably a $15 to $20 billion hole. I think what will happen is the package out of the Senate will have, there's something I've worked on with many others, and Senator Menendez has led out of the Senate, called the SMART Fund with Senator Cassidy. That's $500 billion to go to places that have been hardest hit. That's for our state and local governments. It goes to every level of government, so it's local. There's no size limitations. That will help fill this hole. You know, we take care of places that have been hardest hit in this country, and the COVID storm obviously hit certain parts of America. That's where we need to go in and help rescue, and I think that's what will happen, along with some other steps.
Congressman, wanted to ask you about the current state of the PPP program, and in particular the issue of disclosure and transparency around it. We heard from the Treasury Secretary last week that he does not intend to disclose publicly the beneficiaries of the PPP program. There's an argument for that disclosure insofar as that some taxpayers think they have a right to know where their money went. There's others who say that it creates a competitive disadvantage for small businesses that accepted the money. What do you think?
I don't know. I supported a bill in the House which failed a couple weeks ago, which said that we should have complete transparency. Now, this is taxpayer dollars. I think people have a right to know where those resources went. But I think we also, at the same time, supported more flexibility for the program, right? So you don't want to disincentivize people from taking it. That's why I think we need more flexibility. We've got a deadline of June 30th coming up where people won't be able to take new loans. You know, I think we should extend that out. There are resources left. You're going to have businesses that are hurting and aren't going to be open at the same capacity or open at all, given certain limitations. So, you know, I think we need transparency, but we also need to continue the flexibility with the program.
So Larry Kudlow also talking about the idea that you need to pay people a bonus to get them to go back to work, that some businesses are certainly having a hard time finding enough employees, particularly when they can make more money if they stay out on unemployment. That's an idea we had spoken with Rob Portman, the senator from Ohio, about earlier, maybe a month or so. He brought that up on the program. What do you think about that idea, the idea of paying people to get back to work, trying to incentivize people to get back out there?
Well, I think you want to make sure you don't disincentivize people for going back to work. And if we work out a program where we incentivize them, that's fine. But understand, and this is the balance, Becky, you were talking about, there's people who won't be able to go back to work, either obviously because they can't, or even if they wanted to, because of pre-existing conditions or other risk factors that prevent them, or child care issues, from going back to work. So I think we need to make sure we don't penalize people who are unable, but of course we have to be very careful not to disincentivize people from going back. And so I support ideas that any kind of incentive to get people going back, but not punishing those who literally can't for so many reasons. And I think, again, that's the balance we need to work out. And I really think that's where this is moving and what you'll see in this as part of this next package.
Congressman Gottheimer, I'm sure we will be talking to you again soon. There's a lot of issues that need to get worked out, but it's good to hear that some businesses are able to reopen again in New Jersey today. Thank you for your time.
It's great. And obviously, next time I see you, we'll talk about the stimulus side of infrastructure and SALT, all things that I think are coming after the next package.
Okay. Thank you, Congressman. We appreciate it.
All right, coming up, what you need to know ahead of the first trading day of the week with the sell-off underway. We've got the markets covered from all angles. First with Tiger Cub David Gerstenhaber. Then Mohamed El-Arian weighs in on a new Goldman Sachs report that says mom and pop investors are beating hedge funds this year, and their fees are much lower. We'll tell you the names they're buying and what all this retail activity could mean for the market. Futures right now, we are weaker, down over 600 points on the Dow. You're watching Squawk Box on CNBC. And check out Spotify or Shopify. Is Walmart teaming up with the company to open Walmart Marketplace to Shopify sellers. Walmart says it will start integrating new sellers and expects to add 1,200 Shopify sellers this year. We'll be right back.
It started in 1898, helping clients and communities invest in hospitals and schools, roads and bridges, farmland and forests, small and large businesses, and sustainable cities around the globe. It continues today, more than 120 years later, investing to make an enduring impact on our world.
Our company's talent playbook just went out the window.
We need a partner to help us stay ahead.
Who can help us change the way we work?
That's what Kelly does. Companies of all sizes are having these conversations. Kelly can connect yours with the right talent solutions. Visit that'swhatkellydoes.com.
CNBC's Disruptor 50 list revealed. Innovation accelerated by a global pandemic.
These are the names and ideas shaping the new normal.
Special coverage on air and online begins tomorrow on Squawk Box.
When we founded Tommy John, Tom was obsessed with how to make underwear truly comfortable.
So we reimagined comfort through fabric, fit, and function.
We use soft, breathable, lightweight fabric with stay-put waistbands that never dig and stretch where you need it. We made a women's line so comfortable, there are no visible panty lines and no wedgies, guaranteed.
For a limited time, go to TommyJohn.com right now to get 25% off site-wide. Plus, we'll ship it to your door for free. That's TommyJohn.com. Log on now.
This is cellulose acetate, a plant-based material that's not only extremely durable, but also quite flexible, making it ideal for Warby Parker glasses, which, by the way, start at $95, including prescription lenses. Try 5 pairs for free at warbyparker.com. Oh yeah, about those prescription lenses. Warby Parker glasses come standard with custom-cut polycarbonate lenses that have been treated with scratch-resistant and anti-reflective coatings. Nice. Try 5 pairs for free at warbyparker.com.
Welcome back to Squawk Box this morning. Take a look at U.S. futures, U.S. equity futures this morning. Dow off about 675 points right about now. NASDAQ looking to open down as well, about 160 points off. The S&P 500 looking down about 68 points. One key sector that's been rising and falling with hopes the country can get back to normal soon, the big cruise line operators. Take a look at what's happening there. Norwegian Cruise Lines, Carnival, Royal Caribbean, all off about 10%. Carnival and Royal a little over 9% right now. Also, check out shares of Catalent. It is up on news this morning that it entered an agreement with AstraZeneca to manufacture a COVID-19 vaccine candidate. That stock up over 6.5%. Becky.
Andrew, thanks. In the meantime, Hertz has won approval from a bankruptcy court judge to sell $1 billion in stock. The car rental company is trying to take advantage of a recent rally in its shares as it tries to raise money. Hertz shares had jumped as high as $6.25 a share last week, but came down off of those highs in subsequent days. This morning, they're back down at $2.11. Andrew.
Okay, we got some breaking news just crossing right now from General Electric. Phil LeBeau has that news for us. Phil.
Andrew, a change at the top of GE Aviation. David Joyce, longtime president and CEO of GE Aviation, will be stepping down. Who's replacing him? It's going to be John Slattery, who is the president and CEO of Embraer for the last 4 years, has a long career in commercial aviation, going back to working with a leasing company back 15, 20 years ago. So John Slattery will become the new president and CEO of GE Aviation, moves into that job officially on September 1st, but this is going to be a rather quick transition. David Joyce, by the way, he's been retirement eligible for a couple of years now, and they've been wanting to make some type of a transition, and they are going to be doing that now with David Joyce moving into executive chairman role and then eventually to an advisory role next year, and John Slattery from Embraer taking over GE Aviation. Big move for that company, and one that I think that the market will generally be receptive to, given John Slattery's track record. Guys, back to you.
Okay, Phil, thanks. Let's talk now. Join us to talk about this renewed bout of volatility in the markets. David Gerstenhaber, he's Chief Investment Officer at Acorn Advisory Capital. Last time you were on, I think you're going to say a lot of the same things, David, and that is that the euphoria associated with reopening and the virus peaking might be premature. The jobs numbers may or may not be truly representative of what's happening. A lot of people coming back, but not necessarily new jobs, spikes in cases. When you were on May 21st, we were at about 2,900, so we went up another 10%. After you were on, you probably watched in horror as that happened. Now we're likely maybe to get back down where we were when you were on. Would you just say to people, if you're too long, sell right now and lighten up? Because a lot of the concerns that you had back then, you're just going to repeat today. And I'm just wondering, do you want to just say that? Sell your stocks right now because you're going to be able to go back in at a much lower price?
Well, you know, Joe, I wanted to make sure I didn't say all the same things that I said on May 21st. But in answer to your question directly, yes, I think it's very helpful to have dry powder. I think valuations are unsustainable at current levels. I think the economy will disappoint in the fall, particularly as the government stimulus programs begin to wind down. I think valuations are excessive. And in particular, I think that we will see a little surge in actual activity now as cabin fever gets people out. But I think that's short-term in nature. And over the next couple of months, I think we'll see more disappointing data that the market will have to come to terms with.
Right. I mean, you're incredibly smart. Are you coming to us from Aspen now? I bet you.
I am, yes. Aspen, Colorado. The sun's just rising at this point.
I'd probably love to stay where you are right now. I'm sure it's magnificent. So we know how good you are at doing what you do. But what do you attribute the disconnect to at this point? The Fed's and central bankers stimulating the animal spirits or the economy, or just money looking for a speculative place to go that will end eventually? Because all the things that you're bringing up are apparent to people other than just you, David. So, I mean, the market somehow has disconnected based on something. Do you think it's a sort of an unsustainable, sort of an ephemeral move higher based on stimulus?
I do, and I think there are two key points on stimulus, Joe, that we need to address. One is the monetary side of things. The monetary authorities globally have thrown a tremendous amount of liquidity into markets, and there's clear evidence of speculative. Yep. It isn't a great thing, and I think Hertz is maybe the poster child for the speculative activity. This is a company that was basically bankrupt. Carl Icahn sold his shares at 70 cents. They obviously knew what was going on, and now they're being allowed to do an issuance of stock because the stock has moved up even though the company is presumably bust. So that's point one. Point two, there's clear evidence in the United States that we over-egged things. People are making substantially more money on a short-term basis than they were making when they were employed. And so if you look at the most recent personal income and spending data, you had income up, the better part of 10%, although those actually working had their wages down over 8%. And my suspicion is that as we move into the fall, as Congress begins to come to terms with how substantial the stimulus was, as they also start to come to terms with the debt burden that this will generate, that the likelihood that these programs will be renewed at full force is likely to decline. And so I think that's a problem. The other point that you raised is the employment statistics, in my mind, are a mirage. If you look at what happened, we added 2.5 million jobs. At the same time, those furloughed dropped by 2.7 million jobs, almost exactly the same number. But what was critical to me is that these were in leisure and hospitality and retail, and clearly industries that didn't come back in May because they were effectively closed. And so, in essence, what I believe happened is we shifted the support of these workers from the government to still the government, but funneled through the PPP loans through companies. And unless those industries come back, in a few months, those jobs are going to disappear again, along with the income associated with them.
Right. Over time, we have seen people that stay long build wealth from, it was 780 I remember when I went into a Merrill Lynch training class, and it went, wherever we are right now. So sooner or later, people want to be in, probably, David, unless maybe this is really different this time. So at what level on the S&P or the Dow would you say this is a really good value for people who are maybe in their 30s or 40s and can hold for a long time? At what value would you say, okay, everything that I'm talking about is already in this market? Where would that be on the S&P for you?
Well, look, the S&P, on my numbers right now, is trading at roughly 20 times earnings. And so if you said, let's take 15 or 20% off of that number, you get back to trend valuations that we've seen in the past. So to peg a number, if we're down at 2,500, 2,600, it gets a lot more interesting. I recognize that interest rates are substantially lower than was the case in the past. And so you can say the discount factor is different. What are the alternatives? And to your point, equities still at this juncture look more interesting than bonds to me because you have that long-term optionality. Whereas if you take a 10-year government bond, what are you really going to make over 10 years? Probably less than inflation is going to run, which says you're going to have a loss in real terms. So yes, I think you need to start buying if the market pulls back. Not a tremendous amount, but valuations matter. Not as a timing tool on a short-term basis, Joe, but they do on a medium-term basis. Right. And when valuations are extended, unless you have a surge in economic growth, and I don't mean over the next couple of quarters as we come back, but unless you have a meaningful acceleration in trend growth, you're just not going to make a lot of money.
Right. No, I'm talking about valuation. I'm talking about in terms of if you wanted to get things cheaper than they are right now, cheaper than they've been in the last year or so. There must be a point at which for long-term, unless you have an alternative wealth builder over the next 5 or 10 years that you think would be superior to equities for the long term. I don't know what.
And I don't. And so to peg it at 2,500 or 2,600, I'd be buying substantively, recognizing that your downside at that point is pretty limited and the upside becomes much better. But to answer your question, you didn't really ask it about when does the economy come back. I think 2021 is kind of another lost year, and we're not back to the level of GDP that we experienced at peak in 2019 until probably 2022. So, what you're playing for near term as opposed to long term just isn't that great. But 2,500, 2,600, if we got there, I'd be buying, and I'd be scaling in on the way down to that. But not here. I'd have dry powder.
If there were a vaccine towards the end of this year that would be ready for mass distribution in 2021, you still don't think that there's pent-up demand that would bring the economy, or at least give you green shoots that the market would discount and say, okay, by mid-year 2021, things are going to be much better? You don't think that's possible, or you do?
No, I would agree with that. The issue of mass distribution, that's one where you're the expert, not me, but I'm not a believer that the factories that we'd need to produce this vaccine would be ready in time, number one. Number two, the question is, does it actually happen? And number three, how quickly do people get vaccinated? So near term, to get people back to work, you're still focused on testing. We don't have herd immunity, and I'm not a scientist. You're better at that than me, but I think that the odds on that aren't that high, and therefore I think the risk-reward remains comparatively unattractive for financial assets.
Okay. All right, David, thanks for clarifying everything. Time will tell, and we'll have you back, and we'll update all your views at that point. Thank you.
Thank you, Joe.
Okay. Hey, Becky.
Joe, thanks. When we come back, which businesses closed and which ones out there are starting to see glimmers of a comeback? We've got some exclusive data from Yelp that you need to hear. Stay tuned. You are watching Squawk Box on CNBC.
I'm going to be making a table. I'm going to do a mural.
Do what I do best, build.
Since our beginning, our business has been people and their financial well-being. It's evident in good times with decisions focused on the long term, and crucial when circumstances become difficult. That continued emphasis on people, our advisors, associates, clients, and communities, gives us purpose, strength, and a way forward, today and always.
Focused on improving representation overall, both in the short term, but also in the form of longer term investments in things like education.
I think it's about time that companies understood that it's just as important to have social responsibilities as it is to have a responsibility to shareholders and to employees.
There's a role for business to play in government, encouraging our elected officials to do the right thing. This is not a time to hold back.
Coming up, some key manufacturing data from the state of New York about to hit the tape. We'll bring it to you live when Squawk Box returns.
Land Rover, above and beyond.
We hope you find these digital solutions helpful to bank from almost anywhere. Deposit a check with your phone or tablet. Check balances, pay bills, and more. Send money to people you know and trust with Zelle. Explore all you can do with our digital tools from almost anywhere. PNC Bank.
Yeah.
Hey guys. You know Robert, Tracy, and of course Mark, who delivers our sandwiches. Hi. What's up? Why is Mark here? You said to get this merger done, I should ask Mark. I said ask Markham.
Ever wonder where the people with all the answers get all the answers? Ask Markham, accountants and advisors. States of Play, CNBC and Change Research's exclusive survey. How the virus and economic crisis is impacting the critical swing states that'll decide the election. Special reports all week and on CNBC.com.
Hey, did you?
Yep, done.
And the...
Of course.
And...
Oh, yeah.
All in one
hour.
Behind the world's most productive people is the world's most comfortable chair, the incredible X Chair, featuring patented dynamic variable lumbar support. X Chair's adjustable seat depth keeps users small to tall, comfortable and supported. Available in breathable mesh, HDR foam, or top grain leather. Customize comfortable positions for your neck and arms. And X Chair's patented SiFloat Infinite Recline provides the perfect recline for users of almost any size. This is not your grandfather's office chair. X-Chair supports workers everywhere who find themselves now working from home. Call or click to get $100 off the amazing X-Chair featuring dynamic variable lumbar support. Plus, for a limited time, you can also get free same-day shipping. This deal is good for any X-Chair you choose. Create the world's most comfortable home office with X-Chair. Call or click to order today and receive a 30-day risk-free trial and $100 off.
Welcome back to Squawk Box. Rick Santelli here with breaking news. Yes, our June read on the Empire Index, all that manufacturing around New York. We're expecting a number around -30. We have a much better number, down 0.2%, down 0.2%. Now, that is the fourth negative number in a row. They started in March, but in February we were 12.9, so obviously that's where we're going to comp to. And even though the markets are having big responses to some nervousness about reopening, the fact is we are reopening, and various parts of the country are going to have to start dealing with some of the issues that many suspected would happen, especially as you reopen and we're still in a coronavirus. We're not on the backside of it yet. And the markets, like last week on the Treasury side, have become the favorite, the darling of investors again. We're down 22 basis points in a 30-year bond last week, and it's down another handful today. Andrew, back to you.
Rick, thank you. Hope you had a great weekend. In the meantime, with demand for air travel slowly starting to pick up, some of the planes that have been sitting parked for months are getting back in the air, but it's likely to take a while for those flights to become profitable again. I want to get back to Phil LeBeau, who joins us now with more on that. Phil.
Yeah, Andrew, profitability is a long ways off. These guys are still burning through tens of millions of dollars every day. You need these planes to be at least 75% full before you can say, okay, we're break even on a particular flight, and they're not at that level yet. So, but when you look at the airlines, you need to keep in mind that they are bringing back these planes. Now, a couple of factors here. Some of the airlines have said we're going to block that middle seat, and as a result, we're capping passenger levels at 65 or 66% for a particular flight. So as a result, when you look at the airlines that have brought back flights or that brought back planes in the month of June only, you've got American at 64, Delta at 16, Frontier bringing back 20, and a lot more are on the way in the month of July. All of this is because you've got more airplane seats that are out there. People, as they are starting to fly, the airlines are making more available. Now, it's up 39% according to OAG since mid-May, but when you look at the level since January, still down 66%. So the airlines are nowhere close to getting back to actually making money off of all the seats possible. That's where they would like to be, the January levels. Speaking of passenger levels, the TSA out with the data from over the weekend, and you see that little bit of an uptick at the end there. Well, these passenger levels, they're still down 81%, but 3 of the past 4 days, we topped 500,000 passengers in the U.S., with yesterday being the best day at 544,000. Take a look at American, Delta, and United. These guys are all down, what, about 8 to 9% to 10% in the last week. So they had a rough week. Big drop off, a little bit of a comeback, but down 8 to 9%. And also take a look at shares of Southwest. OAG pointing out that Southwest, as it has added back flights, pretty judiciously, we should point out, it is now, because of all the fall off in China, it now has more seats available than any other airline in the world. And that's not a surprise given what we've seen over in China in Southeast Asia. Guys, back to you.
Hey, Phil, there's just some news crossing on United. I don't know if you've had time to look at this yet.
I have.
To see what's going on. What's happening?
Well, you've got a couple of 8Ks that United is dropping, and this is big news in terms of what the airline is going to be doing. The airline has essentially lined up a loan for $5 billion. The collateral for that loan, basically it's going to be backed by the Mileage Plus program. That's the frequent flyer, the loyalty program. This will help them, along with a Treasury loan that they're going to be applying for, have about $17 billion in liquidity by the end of the third quarter. That's $5 billion, and then another $4.5 billion they expect to get through Treasury. That will be backed by slots, gates, routes, not by aircraft. So between those two, United expects to have about $17 billion in liquidity by the end of the third quarter, with a cash burn rate coming from $40 million a day in the second quarter to $30 million a day in the third quarter. But they are doing this, guys, basically lining up the possibility that they're going to need even more liquidity, especially if there's a second wave of COVID-19 and we see a further contraction in terms of flying both here in the U.S. and around the world.
Phil, explain how the loyalty program is worth $5 billion, because that's really just the information on the passengers, right? If those passengers aren't traveling, aren't spending like they used to, what is the value there?
No, when you're looking at the Mileage Plus program, $5.3 billion in sales last year, Becky, $1.8 billion in EBITDA. So they're monetizing that program by essentially saying, okay, this is going to be backing a loan facility for $5 billion. By the way, they expect that they will keep this open.
That was last year.
And from time to time tap it.
What's the revenue and the EBITDA this year?
They did not give that. They just gave us a briefing on that. Becky, but if you look at airline bankruptcies, and we've said this going all the way back to 2000, if you look at all of them, what is the holy grail when it goes to bankruptcy that is protected first and foremost before anything else? loyalty programs, because they're the most valuable asset in many ways that the airlines have. And what United is doing here, and we'll see this likely with other airlines as well, is to say, okay, you know what? We will collateralize this. This will be the mortgage behind this $5 billion loan. You've got 100 million subscribers, and you're bringing in more than $5 billion a year in sales. I think that they believe that this is a smart move, and I think most people will look at it that way, and you'll see other airlines doing something similar in the future.
Look, I think it's a smart move for the airlines. My question is that, you know, it was worth $5 billion last year. What's it worth this year? Show me the numbers this year.
Becky,
and tell me when you think it's going to get back to those numbers. You think it's going to be back like that next year? Maybe. But
well, let me ask you this, Becky. If you are a Mileage Plus member, are you canceling that credit card or that program? Are you still spending through that credit card? Are you still spending through that program? And this is not tied into the credit card alone.
I mean, I think most of the people that have those, here's my thought on this. I think most of the people that have those credit cards use those credit cards mostly when they travel, because there are so many rewards that are connected to it, whether through your mileage.
I disagree. And by the way, Becky, this is not tied into the revenue with the credit card. It is tied into the revenue with the program. Now, with the revenue with the program, it's certainly going to be impacted by fewer people are flying. So your point is correct in terms of what is the value of the program this year. They believe that as more people fly, they'll eventually get back to that $5 billion in sales. But in terms
and that's where the question comes in. That's where the question comes in, is how much is it down this year and how quickly will that return? And I mean, that's the big question on everything happening with the airlines. How quickly are people going to be flying again? That's the unknown.
Right.
That's,
look, and nobody's expecting profitability by the end of the year. But what they are doing here by lining up the $17 billion in liquidity is making sure that they are in position.
I think it's smart on their part. I would question whether the underlying value of the program is still that. I drove by Newark Airport for the first time on Friday, Phil, and I was shocked, because even though I don't really see planes in the air all that much, and every time I do, it's enough for me to stop and take a look at them, I had not driven by any of the airports yet. That was the first one I drove by. There wasn't a plane that was landing. There wasn't a plane that was taking off. I didn't see too many planes at any of the gates, and it was just kind of this awesome reminder of this airport that when I used to drive by it all the time would be completely jammed with the planes lining up to come in. Even as you see people start to come back and 500,000 people traveling again, that still is such a small fraction of what we've been seeing before.
Becky, they're a long ways off from where they were pre-COVID-19. There's no doubt about that. And let's be clear here. The big problem, it's the corporate traveler. The corporate traveler is just not coming back anytime soon. So as encouraging as it is that more people want to go, and that's the most profitable. More people may want to go to Florida. Right. It doesn't really matter until you and I are on a trip, let's say to Dallas or to somewhere else.
Phil, thank you. It's great to see you.
You bet. You too.
All right, let's get back to the on-the-ground impact of the coronavirus. Yelp's data science team has been gathering information on business closures since the start of the pandemic, using the over 200 million reviews and photos. Their new data, which is exclusive to Squawk Box, is helping to reveal more fully the economic impact of this crisis. For instance, since March 1st, retail represents 23% of all the business closures on Yelp. Of those, 27% are indicated as permanent closures. Restaurants are also getting hit hard, as 48% indicated they could not come back from this crisis. Joining us right now for more on this data is Justin Norman. He is Yelp's Vice President of Data Science. And Justin, we're excited to have you here today because we are having such a hard time trying to use the normal economic data that we follow on a weekly or monthly basis to try and figure out what's happening in these very unusual times. So what you're doing really offers some real-time insight into what's on the ground. First of all, tell us about how many businesses have actually closed during this.
Absolutely. Thank you for having me. So as of June 10th, and as you mentioned, we've been capturing this since the beginning of March when the shelter-in-place orders really came into effect. We've seen more than 143,000 total business closures. And what we're seeing within that data is that over 35% of these are marked as permanent closures by businesses, which means that they are not expecting to reopen according to what they're reflecting on Yelp. And it's important to note that this is just a reflection of what Yelp is able to see as businesses mark that data on our platform. So there actually could be more or hopefully slightly less, but it is a reflection of what we're seeing.
In terms of the breakdown, what retail and restaurant we know are a big part of them. What percentage do they each make up?
Sure, absolutely. So as you said before, retail makes about 23% of total businesses closed since March 1st. and restaurants are coming in at about 17%. It is really telling that restaurants in particular are 48% of closures are marked as permanent. So even though restaurants have a higher degree of closures overall, we're seeing that some restaurants might have had very little reserved cash as we went into the pandemic and had to close immediately. And then later in May, or most recently, we're seeing a second wave of closures really come in for restaurants. And that's when some restaurants who have been able to find a way to survive for a period of time ran out of that cash reserve or realized that the secondary mechanisms of making money just weren't enough and are transitioning now into a closed state.
We also saw on the screen the idea that beauty salons and others had been closed for a long time, too. What other businesses have been affected?
Yeah, absolutely. So beauty actually makes up about 13% of the total businesses closed and is a smaller overall percentage of businesses that are tracked on Yelp. But we are seeing something interesting in beauty in that there aren't as many permanent closures and aren't as many total closures. So 18% of the 13%